Thank you everyone for joining the call, and I hope you and everyone around you is safe and in good health. Along with me today, I have Max Ventures' experienced senior management team on the call. We have our CFO, Mr. Nitin Kansal, Mr. Rishi Raj, Chief Business Development Officer, Mr. Ramneek Jain, CEO of our packaging business, Mr. Rohit Rajput, CEO of Max Asset Services, and Mr. Nitin Thakur, Director, Brand and Communication of the Max Group. We also have SGA, our Investor Relations Advisors, on the call. Let me first start by giving you a strategic view of where Max Ventures is. The last quarter has been extremely challenging, not only for the entire industry, but for the world at large. We are delighted to share that Max Ventures has performed extremely satisfactory and has very positive results to share for this quarter. First, we continue to cement our position in the commercial real estate business, while specialty films is proving to be a dependable cash generator. In real estate, timely and high-quality completion of Max House demonstrates that we can create high-quality office complexes on schedule, faster than most other developers, and within budget. We also have a very strong project pipeline with mid-teen or higher margins and proven access to international high-pedigree financial partners such as New York Life to enable asset-light growth. Our real estate business is net debt zero. Our internal stress tests show that we can navigate even longer than expected economic slowdown. The uncertain business environment has impacted fresh office leasing, but Grade A and Delhi NCR will revive faster, and we can benefit from distressed opportunities as well. The EBIT and contribution margin in packaging films business will remain firm due to our continued demand, our value-added strategy, and reduction in the supply overhang. Let me now give a more detailed business performance overview followed by financial highlights. Q1 FY21 has been a strong quarter for Max Ventures, recording a revenue of rupees 2586 million. Max Ventures recorded its highest ever operational EBITDA and PAT of rupees 470 million and rupees 131 million respectively in Q1 FY21. If we exclude the Q1 FY20 quarter, where a one-off sale transaction was undertaken for a small portion of Max Towers and a partial stake sale of our investment in FSN E-Commerce Ventures, the holding company of Nykaa business. I will now request my colleague Rishi Raj to give you an update on our real estate business.
Thank you, Sahil. Now let me give you an update on our real estate business. I'm very pleased to announce that we have received completion certificate for our second Grade A plus commercial offering, Max House Phase 1, comprising of 105,000 square feet leasable area. The project will be launched for leasing in the current month, August 2020. We did our first ever digital launch for the channel partners for this project in July. Max House is strategically located with excellent accessibility and connectivity to entire NCR and will be the only Grade A plus office in that micro market. It will have similar components of our work well philosophy that have been appreciated by tenants at Max Towers. We have also worked extensively with our infra and tech partners to ensure that the complex has the best-in-class health and hygiene features and SOPs. We expect to attract similar reputed tenant profile for Max House, like in Max Towers, which comprises head offices of Indian and foreign multinational companies. We have developed product and pricing innovation for this project and thus very confident to achieve respectable occupancy levels by the end of fiscal year 2021. Work for the second phase of the project, which is part of the same campus, with a similar leasable area as in phase 1, is expected to commence in Q3 of fiscal year 2021. In spite of disruptions caused by COVID-19, we are delighted to share our rental collections in Max Towers are healthy at more than 90%, which is a testimony to our strong and reputed tenant profile. The total leased area in Max Towers now stand at 275,000 square feet, which includes both Max Estates and for investors, for which Max Estates has the leasing rights. Leased area attributable to Max Estates stands at 140,000 square feet. As the lockdown started easing, we have witnessed increased inquiry for our space in Max Towers and Max House as well, though new leasing activity in the industry remains slow as occupiers reassess their office space requirements. With increased inquiries and footfalls, we expect to start gaining back the leasing momentum from second half of this fiscal year, which earlier was impacted due to COVID-19. Now coming to our next project, Grade A Plus commercial project, Max Square, located at Noida Expressway. Again, delighted to share all our statutory approvals, including building plan, environmental clearance is in place, and that in a record time of 5 months, despite COVID-led lockdown of 3 months in between. We expect to commence the construction in Q2 of this fiscal year itself. Max Square is approximately 0.7 million square feet project designed to house commercial office space, F&B, entertainment areas, and other amenities. It will, we are very confident, will redefine the office offering in this micro market, addressing the current pain points of the occupiers while also factoring in future needs, implementing our work well philosophy. New York Life, as we had updated earlier, is 49% investment partner with us in this project. This will be Max Estate's largest project till date. Max Estate will be responsible for the final delivery of the project and will be entitled to a development management fee on this project. The project is targeted to be delivered by Q4 of fiscal year 2023. Another update on projects, the distress project Delhi 1, which we had bid for, is still under NCLT for further hearing. We have already received approval from Committee of Creditors and have been declared as a successful resolution applicant. Our resolution plan, which was voted by Committee of Creditors, is now with NCLT for final approval, which has got a bit delayed because of lockdown. We expect to get final clearance by the end of this fiscal year. In our last call, we updated you about several business development initiatives, including innovative product and pricing solutions like zero capex plan, addressing cash conversion needs of the occupiers looking to relocate to new office space. We also updated that we are investing in getting ready with digital toolkit to build awareness, generate leads, as well as engage clients, keeping in mind travel restrictions. I'm happy to share that these initiatives are not only implemented in time, but also generating positive outcomes for us as inquiries have started increasing. Let me share an example. The virtual tour of Max Tower office asset has been now used by our team with several decision makers and influencers at the client base outside Delhi NCR, and in several cases outside India as well, and is helping us in getting shortlisted for further considerations by our clients. During Q1 FY21, many large occupiers have restarted reassessing their office space requirements and firming up plans to move from expensive, old and strata-sold offices to developer-owned and managed offices with reasonable rentals to save cost without compromising on quality and safety. Max Estates is targeting such tenants currently located at expensive and old offices in Delhi and in Gurgaon. The company is witnessing inquiries already with such relocation intent. We expect occupiers will prefer Grade A Plus developer managed offices in Delhi NCR, which offer safety, security, continuity of operations and healthy working environment. Our office spaces are well equipped with high-end new edge technologies which are necessary to monitor and implement safety and social distancing measures to ensure a hygienic and healthy working environment for all our tenants. Work from home may impact demand, but at the same time, there are several positive forces at play, like de-densification, and deconsolidation of office space, which we believe may counterbalance this decrease and is already getting factored in the decision-making of several occupiers with whom we are in discussion. We believe that demand for commercial offices in NCR will be impacted in short term, but an important point to note is supply is also expected to fall due to NCR-based developers' inability to complete the projects on account of overstretched balance sheet and lack of liquidity. And this is already visible in the IPC's report for first half 2020, where fall in supply for NCR is higher than demand versus what is true for Pan-India in general. Max, being a credible brand with focus on Grade A plus commercial office segment, strong balance sheet with zero net debt and access to institutional equity capital, is well placed to capture the market as industry grapples with consolidation. With this, I will hand over to my colleague Rohit Rajput to give an update on Max Asset Services and Max Investments.
Thank you, Rishi. Now let me give you brief highlights about Max Asset Services and Max Investments. I'm happy to update that Max Asset Services, our real estate focused service vertical, has delivered its second managed office project at Max Towers for a Fortune 500 client. Max Asset Services has been playing a pivotal role in implementing new age technology solutions such as a mobile app, video analytics, advanced air filtration, and visitor management in offices, which are essential to provide a pleasant experience for the tenants, along with zero tolerance for any lapse with respect to health and safety of our tenants. A promise core to our work well philosophy. We expect many tenants to avail services on this premise going forward. At Max Investments, we continue to engage with many RE tech startups, identifying and implementing technologies that will aid us in our work well philosophy to drive both physical and emotional well-being of our tenants. I now call upon Ramjeet Jain, CEO for Max Specialty Films.
Thank you, Rohit. Hello, everybody. I'll take you through some of the exciting things happening at the Max Specialty Films Limited. Q1 FY21 has been a strong quarter for our packaging films vertical. Our manufacturing facilities being covered under essential services, had continued to operate smoothly even under the lockdown during Q1. We are observing a strategic shift in consumption pattern, with people moving towards more packaged food versus open food purchase, which should result in a shift towards branded products consumption. Both these movements support MSFL as demand for packaging material will increase, especially in the food segment, leading to new business opportunities. We continue to be one of the preferred suppliers to the brands as MSFL brings innovation and new technologies with one of the world's most advanced BOPP facilities and a backing of a global leader in printing and packaging technology, that is Topan. Increased adoption of packaging foods from brands will enhance packaging films demand. As consumer is becoming more aware and sensitive towards health and safety of packaged foods, MSFL is leading the way by targeting antimicrobial and antiviral films. MSFL is working with stakeholders to quickly commercialize these films and also growing specialty exports through direct customers and Indian customers with global presence. We continue to move up the value chain with higher share of value-added specialty films while keeping a tight control on cost, enabling us to steadily expand our profitable margins. As a result, our EBIT has nearly tripled to 400 million in Q1 FY21 as compared to rupees 140 million in Q1 FY20. And EBIT margins expanded year over year to 15.9% in Q1 F21 from 5.7% in Q1 FY20. MSFL reported a revenue of 2,512 million in Q1 F21, up by 3% year over year. Net external debt in our packaging film business has come down to rupees 3,988 million as of 30th June 20. And we aim to continue on this path of deleveraging the business using surplus cash flow. The best of the brands like HUL Pepsi, ITC, Nestle, to name a few, and many other global players have chosen us as a preferred partner to develop innovating packaging solutions directly for them and ensure faster specialty commercialization. In line with our value strategy, we have planned to set up a new metallizer line, which is expected to be up and running by the third quarter of FY 2021. This line will not increase overall capacity because the base film remains the same, but it will enhance MSFL's ability to improve the value-added specialty component in its product strategy even further. This new metallizer line is being developed at an investment of rupees 30 crores, contributed by Maxwell and its strategic partner Topan in the ratio of their existing shareholding pattern, that is 51-49. With favorable domestic and export demand, stabilized supply, and improved realizations, we expect healthy profitability to continue in the coming quarters and this financial year. Thank you. With this, I hand it over to Mr. Nitin Kansal, CFO Maxwell. Nitin, over to you.
Thanks, Ramneek. Good afternoon, everyone. Let me give you the financial highlights for the quarter 1 FY21. The consolidated revenues for quarter 1 FY21 stood at 2,586 million rupees as compared to 4,255 million rupees in quarter 1 FY20. Here, I would like to highlight that the numbers of the quarter 1 FY20 are not exactly comparable to the numbers of quarter 1 FY21, as we had recorded one-off transactions in the previous quarter same year. We had recorded the sales transaction of 1,618 million rupees in Max Towers and had also recognized gains from an exit in Nika, equivalent to 185 million rupees. Doing an apple-to-apple comparison, our revenues have in fact increased by 5.4%, that is from 2,452 million rupees in quarter 1 FY20 to 2,586 million rupees in quarter 1 FY21. So for better comparison, I like to give you the profitability numbers based on these adjustments of one-off transactions. EBITDA for quarter 1 FY21 stood at rupees 470 million as compared to an adjusted EBITDA of 147 million in quarter 1 FY20, up by 220% year-on-year. The EBITDA margins have increased from 3.5% to 18.2%, an increase of 1470 bps year-on-year. The consolidated profit before tax stood at 237 million in quarter 1 FY21 as compared to a loss of 57 million in quarter 1 FY20, thereby signaling company coming back in profitability. The profit after tax stood at 131 million in quarter 1 FY21. Coming to the segmental highlights. Our real estate business, that is Max Estate Limited and its subsidiaries, recorded a revenue of rupees 47 million in quarter 1 FY21. Of that, the lease rental income of Max Towers stood at rupees 44 million. We have achieved a weighted average rental of rupees 100 per square feet at Max Towers. Revenue for Max Asset Services stood at rupees 24 million in quarter 1 FY21 as compared to rupees 21 million in the previous year, same quarter, up by 140%, a little bit with us on a low base. We expect a gradual uptick in the revenue as more management contracts are getting added to our portfolio. Our packaging films vertical, MSFL's revenue stood at rupees 2,512 million in quarter 1 FY21 as compared to 2,437 million in quarter 1 FY20, up by 3.1% year-on-year, and even on a sequential basis, the revenue is up by 7.4% quarter-on-quarter. EBIT for the packaging business stood at 400 million in quarter 1 FY21 as compared to 140 million in the same quarter previous year, up by 146% year-on-year, and on a sequential quarter basis, 83% up quarter-on-quarter. The packaging film business has witnessed a strong expansion in EBIT margins of 1,020 bps, increasing from 5.7% to 15.9%. Sequentially also, the number has increased from 9.3% to 15.9%. The total volumes in the packaging films stood at 16,258 metric tons as compared to 16,000 tons in quarter 1 FY20. Our focus on the packaging film business has been on the value growth and not on volume growth. The value-added specialty films contributed 39% to the packaging volumes in quarter 1 FY21, and the corresponding revenue was 46% in quarter 1 FY21. The specialty films volume contribution was lower quarter-on-quarter as demand for thermal films, which has industrial applications, were affected due to COVID-19 lockdown. I'll also like to give you a brief update about our liquidity position. The gross debt in our real estate business as of 30th June stood at 1,072 million rupees, against which we have liquid investments of 1,165 million. Thereof, we are in a net debt-free situation and with the cash in our hands. We have sufficient liquidity to service the debt of real estate business and at the same time well-funded to complete the projects which are currently under development. Hence, we are in an extremely strong position to deliver the projects as compared to other developers which are facing liquidity constraints. Gross external debt in our packaging film business stood at 4,015 million. Excluding cash and cash equivalents, we had a total debt of 3,988 million in our packaging film business. Our packaging film business continues to operate with healthy margins, and cash flow from the business is sufficient to service the debt of the businesses. Now, I would like to hand over this back to Vikram for opening the session for the Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1. We have a first question from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead.
Good morning, sir. Hope all is well at your end. My question is pertaining to your real estate business. If my understanding is correct, you have a quarterly rental revenue of around 4.4 crore. So I just wanted to, first question is just wanted to understand this 4.4 crore is derived from how much leasable area. I mean, Max Towers Noida, you have 0.6 million, and if we multiply 0.6 with 100 rupees per square feet per month, then the number doesn't match. So I just wanted to understand what is this 4.4 crore this rental. It is derived from how much area and from how much area, and I think it is derived from Max Towers. This is my first question. Hello.
Biplab, if I can answer that, can you hear me? Hello.
Yes.
Yeah.
Yes, sir. Go ahead.
We have a total area of 292,000 square feet leasable area at Max Towers, of which 140,000 has been leased as of 30th of June. So the revenue which has been accounted for in the books is for only 140,000 square feet in the quarter.
Okay. So, sir, my understanding is now you have around 1.5 million in Max Towers Noida and around 1.1 million in Max House to be leased, right, sir?
Yes. 1.05 lakhs to be leased at Max House, Oakland.
Okay. Second question is, sir, you have a big project, Max Square, that is coming up in the Q2 FY21, and also you have remaining area to be built in Max House, Oakland. So, sir, I know you have a net debt of zero net debt. Just trying to understand how will you fund these two projects going forward? If I hear from what I hear from the market, is funding is going to be a little bit of people are facing a little bit of difficulty in funding. I'm sure Max can easily get funding, but nevertheless, just trying to understand how will you fund these two projects, Max Square Noida and Max House, and 50% debt, 40% debt. You are trying to get some equity partner. Just trying to understand the project finances. Yeah.
Sure, Viplab. Viplab, what is happening in the case of Max Square Noida, we have got New York Life as a 49% partner in the project, and they have committed to deploy a total equity capital of 87 crores, of which they have already deployed 68 crores as we speak now. So in terms of the total outlay for Max Square project, which is close to 400 crores, we have an equity commitment of 175 crores, 51% by Max Estates and 49% by New York Life. And both the partners have already deployed more than 80% of their equity in the project. This leaves us with to raise a debt of close to 200 and 220 crores, which is required. Now, this leads us to a very interesting question. In our interaction with the debt providers, one thing which has clearly come out is that people are not being able to have a closure on the equity part when they are going for raising of the debt. In terms of Delhi NCR, we would be one of the few developers who have already put in the money, the equity piece upfront for the completion of the project. And as we speak today, what we are trying to see is all the cuts which are being provided by the RBI and the liquidity available with the banks. We are trying to make most of the benefit of this liquidity cuts and rate cuts available to us. So for us, the question is not about raising of the debt. It's the question of the raising of the debt at the most optimum pricing. So as we speak today, we have got equity close from Max Square, and we are in touch with a number of bankers, and we're just trying to optimize our cost for the debt piece which we want to raise. Now, coming to the second question which you had asked about Max House Phase 2. The Max House Phase 2, we have already funded the project in terms of acquisition of the underlying land to an acquisition of the company called Farmex Corporation. Now, as we speak today, the way we think about it is that our Phase 1 project, which is already up and running, has a potential to raise an LRD, which is against the lease rentals of the project. As we go forward, as and when we are able, as we progressively lease our Max House Phase 1 by the fourth quarter of the current financial year, we would be able to raise LRD or to complete our Phase 2 project. We are not looking at raising construction finance or debt for a Phase 2 project as of now. Okay. And again, very, very important part in this aspect is since it's already equity funded and the sponsor is not proposed to bring in the equity, it brings a lot of positive vibe for the debt provider also.
Okay, sir. Thank you, sir.
Thank you, sir. We have a next question from the line of Manan Shah from Moneybee. Please go ahead.
Hi, thank you for the opportunity. Sir, my question was relating to our packaging business. If you could highlight what were the spreads during the quarter versus last quarter and same quarter last year, and whether you expect the current prices that you've realized in this quarter to sustain for on a medium-term basis?
Okay, Manish, thank you. I'll take this question. This is Ramik, CEO of Max Specialty Films. So on the spread, I'll ask Nitin to talk about it. With regards to the pricing, I think there are two big variables here. One is the overall market pricing with regards to commodity. Directionally, we feel that prices should be okay, but it is seen as high volatility, which is at times beyond any logic or a strong logic. But nonetheless, for us, as far as MSFL is concerned, we think it should remain strong, and primarily because of our continued success in our value strategy that we see. And so where our products and the relationship with the customer and our interdependence on each other continues to keep our pricing strong and linked to raw material in some cases, and thereby protecting our earnings. Nitin, do you want to add something on this?
Yeah, sure. So I'll just, Manan, just to give you a number on the numbers front. We had in the quarter 1 FY20, we had EBIT margins of 5.7%, which moved on to 9.3% in quarter 4 FY20, and which has further expanded to 15.9% in quarter 1 FY21. Right. So there has been a gradual ramp up in the EBIT margins over the period of the last 3 to 4 quarters.
Right. But could you provide some color on the spreads between the BOPP and the PP right now currently that are going on in the market?
Okay. Help me understand your question. When you say BOPP and PP, you mean
polypropylene and BOPP commodity films that we sell.
So, not in terms of the sourcing of raw material, but you're saying the prices of the commodity and specialty. Did I get your question right?
Yeah, it's pertaining to the commodity film, because I understand that in specialty we would have pricing power, but in commodity the prices would be decided by the market forces, by the demand and supply.
Right. So I think I shared a little bit on that. So commodity prices remain relatively strong.
Okay.
And we see good strength, and I think given the demand and supply overall of packaged goods increasing because of the COVID and the hygiene appreciation of that, the demand remains high and the supply is fairly constant in the industry. So even on commodity side, the prices remain high, relatively speaking. Obviously, the specialities that I was mentioning earlier, because of a value strategy, we are working hard to increase and retain the delta that we can command on the speciality. But to your specific question on commodity prices are looking strong.
Okay. Thank you.
Thank you.
Thank you, sir. To ask a question, participants will press star followed by 1 on their touchtone phone now. We have next question from the line of Patrick Samuel from Gravity Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity. So first of all, I would just like to understand what is the leasing momentum that we are witnessing currently, and do we expect any conversions happening from the inquiries that we are getting recently? Second question would be, as a lot of companies are now preferring to adopt work from home mode of operating. So how do you see it affecting the demand going ahead? And lastly, about our Max Towers, have we seen any customer coming to us and asking for any reduction in the rental rates? Thank you so much.
Yes, I'll take that. This is Rishi. So you had 3 questions. On first question, which is with respect to leasing momentum. Yes, absolutely. Over last several weeks, we have seen a significant rise in inquiries from a week-to-week perspective. And as we speak, we are in active discussions with some very solid prospective clients, both for Max Towers and Max House Okhla, and we are very confident that some of this will get converted in quarter 3 of this fiscal year. So the answer on that is yes. With respect to overall demand scenario for office space, I think our view is very clear. We believe relative to other asset classes, commercial real estate will have a limited impact, and within that, in particular, grade A plus office assets and developers will be least impacted and will see sharper recovery. Of course, the elephant in the room is around work from home. Work from home will have some impact. There are varying numbers out there, maybe to the extent of 10-15%. But what we need to also understand is there are positive forces at play which we believe will counterbalance the negative impacts, so as to say, from work from home. As I mentioned in my commentary, especially with respect to de-densification and diversification, and that is no longer a theory. In our discussions with a lot of occupiers over past several weeks, this is becoming a reality in their real estate strategy, both de-densification, more space per square feet per person, and as well as diversifying into multiple locations. So overall, with that, as well as a general acceleration one expects to see towards offshoring and outsourcing will lead to, especially from US and European companies, will lead to further increase in demand from a mid to long-term perspective. And I think the other important point one would need to understand is while demand is getting impacted in the near term, the supply is getting impacted even more sharply. So if you look at the report from Knight Frank for first half of 2020, the decrease in supply is 1.5 times more than the decrease in demand for first half 2020. And that's where we believe grade A plus developers like us will benefit significantly. Coming to your third question, with respect to rental waiver or renegotiation, none. I think we have been very successful with our tenants at Max Towers. While we may have supported a select few from a liquidity standpoint for a month or so, but no rental renegotiation, no rental discount, which also speaks volume of the quality of the tenant which we have been able to attract at Max Towers, and we are very confident to attract tenants with similar profile in Max House Outlay as well.
Thank you so much. Thank you so much. That answers my questions.
Thank you, sir. We have next question from the line of Chirag Singhal from First Water Fund. Please go ahead.
Hello. Yeah, thanks for taking my question. I have a couple of questions on the films business. So first of all, if you can help me explain that, like, if we compare our margins, historical margins in the BOPP films with the peer set, our films margin has remained on the lower end. So is it because I see from a presentation that approximately 40 to 50% we have specialty films as our total films, and so is it because of we have less exports and more domestic sales, or why is that so?
Okay, Mr. Singhal, this is Ramik. I think it's a good question, and it's a strong focus for me and my team to how to narrow that gap and edge forward. Some of the reasons we can say, and we are studying those hard, are some areas of structural improvement that we have, while some may not be able to be addressed right away in terms of location and the location of some of my competitors to ourselves being it up in the north side, away from the port, but add certain challenges. At the same time, we have our own advantages as well. So at the end of the day, the effort is to be able to reduce the gap between us and our competitors on the earnings side. And I think the industry that we are in has a long gestation period with regards to product maturity, product stabilization, and we are catching up on our value strategy. And as we have been on it for the past couple of years, I would say, especially in the past 1.5 years, getting in there. So we are seeing much higher traction of our specialty products. The journey requires products to take its roots and win the confidence of the customer, and then slowly edge upwards in terms of its realization by continuing to add more value to the customer. And I think that is a journey which we keep saying that is helping us. But I can surely say that we have a long way to go in terms of, continuously upgrading our product pipeline. We have a healthy line of products going in right now under the various stages of testing. New ones are in its infancy, so like the whole product pipeline. So I think the direction is right. The efforts on the cost side, efforts on the customer positioning, geographical positioning, export versus domestic. I think all of us in the industry, and we have strong, worthy competitors. I think we are moving up in our realization of the efforts that we have put in, and I think in the coming quarters, it is our personal goal as well to narrow that gap and take the lead.
Okay. No, that's a really good assurance, sir, from the management side. Appreciate that. That quite answers my question on the margin differentiation between you and the peer set. Now, my second question is on the current scenario, which is like we are seeing robust margins in both BOPP and BOPET, and from your standpoint, BOPP. So we saw 70% margin expansion sequential basis in Q1 in your packaging films. So how are you seeing the margins? Like, are you foreseeing that Q2 will be better than Q1, or is it going to be on the same wavelength, or are you seeing any improvement, that is downward improvement in the realization of the margins?
Well, Mr. Singhal, I think we had a strong Q1. And once again, I'd like to bring it to the forefront that we had a strong Q1 compared to our competitors, I think, because of the fantastic culture of the Max Group wherein we had all our employees supporting us to work in the most challenging of times. And I really want we take a lot of pride in that. And I think that loyalty of the people is a very strong power for us. When we say business is all about people, we actually lived through that in the first quarter. With a strong Q1, I think Q2 is also strong. Would it be stronger than Q1? How much? It's a matter of still time. It has started well. I think, the question on margins, I would say that while on the logical front, in terms of the demand and supply, in terms of the raw material, in terms of the product mix, we do not see a reason why even on the commodity side or on the pricing side, we should have a negative impact. With that said, of course, industry takes its own, stance and its own, I wouldn't call it cyclicity, but decision-making of the independent competitors. Our endeavor remains to continue with every passing day to increase our speciality, and be able to command a higher margins on those. And we feel quite strong about it, and we feel quite confident about it.
Okay, understood. And is it possible to give spreads like rupees per kg, if you can give, just to understand the trend of the industry? What was it in Q1 FY20? What was it in Q1 FY21 and Q4 FY20? Gross margin?
Okay. So, Nitin, you want to give some inputs on the overall margin percentages?
Percentage, or maybe if you can give in absolute terms.
So, Chirag, we can provide you the numbers. EBIT margins, as I mentioned, was that EBIT margins have increased 9.3% from 9.3 to 15.9% sequentially, and have increased from around 6% to around 16% over a period of last 1 year.
Okay, all right. Okay, fine. So one more last question. How many BOPP lines, according to you, are going will be on stream in the next 12 months? Just to understand the demand and supply parity of the industry.
Right. So, in my understanding, in the next 12 months, we should see about 2 to 2.5 lines come on board. When I say and a half means, the ramp-up period, etc. That is what we see as of right now. But again, I would like to also add that as we have taken our value strategy, me and my team are working strong, and we foresee that MSFL should become much more immune or less impacted with the demand and supply on the commodity side. So, so that is what our journey is. And while there will always be remaining a very strong demand for the commodity, and thereby the supply implications of it and its attraction to the market, we have chosen to go the value strategy way. And our competition or to ourselves, or our challenge to ourselves, is to increase in that side, where you may be selling lesser volumes relatively, but we should be able to compete and meet our goals for the stakeholders.
Okay. All right, that's it from my side. Thank you so much for your detailed explanation.
Thank you.
Thank you, sir. A reminder to participants, to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Ankit Agarwal from Arc Capital. Please go ahead.
Yeah, thanks for the opportunity. I have a couple of questions on the real estate business. So, sir, first question is, sir, in the current situation and environment, do you expect the office rentals to go down as the new demand may reduce?
Yeah, I'll take that. So as far as office rental is concerned, it's very difficult for us to comment on this at this point of time, as the real impact of crisis will only be felt in due course. Having said that, in our view, the rentals for old strata sold buildings may be impacted. However, and this we are seeing playing out on the ground, for the grade A plus building by credible developers, rental is holding on across NCR. And we would like to point out that this is also proven in the last lease that we signed, as we had updated last time, during COVID, which we signed at a rental more than what our weighted average rental for Max Towers is. And we are very confident as far as our Max Tower asset and Max House asset is concerned, we will be able to preserve those rentals, especially given the demand for people who want to relocate from high cost, expensive, old, startup sold central business districts for a better managed, better quality, and the emphasis on health and safety and wellness, right? So that's how we look at it.
Okay, that's pretty positive to hear. Sir, one more question is on the Max House. So when do you expect the phase 1 to be fully leased, and what is the expected rental income?
Yeah, so on the part 1, in terms of getting fully leased by first quarter of next fiscal year, that's our target. On the expected rental, I will pass it on to Nitin.
So we are expecting rentals in the range of 15 to 18 crores to come once the Max House Oakla is fully leased out.
Okay. Okay, fine. I have one last question. It's on your investments in Nykaa. So what's the current status of that and the restaurant chain?
Nitin, please go ahead.
Yeah. So Ankit, what is happening? We have got around 0.5% holding in Nykaa. And Nykaa did a last round of funding in the month of April, in which they had raised capital at a valuation of around $1.2 billion. Right. And we are currently still holding with our investment. And the second investment which we have currently is in a F&B company called Azure. And the second investment is in a company called Azure Hospitality. Now that is also running fine. And although they had some challenges with regards to the COVID lockdown, and the industry is going through a lot of upheaval, but the business has started in a limited fashion with the gradual opening of the lockdowns.
Okay, fine. That answers all my questions. Best of luck.
Thank you.
Thank you.
Thank you. We have next question from the line of Shivam Junjunwala from Lucky Investment Managers. Please go ahead.
Hi, sir. Thank you for the question. Just had one question regarding the Max Towers rentals. So this quarter, we've done approximately 44 million in rentals with 140,000 square feet leased. While the previous quarter, we had about 66 million, and we mentioned that we had more than 50% of Max Towers leased. So I'd just like to know that what changed and what can be a sustainable number looking forward.
Right. So just to answer that specifically, when we say 50%, it's from the 50% of what we own. We own around 292,000, of which we have been able to lease out close to 145, and of the square feet of the leasable area. And in the current quarter, we had a tenant called IEX which signed up in the phase of the lockdown. As you know, in the first phase of the lockdown, we had certain cases where the people get certain rent-free fit-out periods, for which the revenue is not accounted for in the books of accounts. In going forward, we can expect, as you mentioned, a weighted average rentals of 100 rupees. We can expect a rental of close to 1.3 to 1.4 crore rupees coming to us on a monthly basis on the leases which we have signed currently.
Okay, and how did we have the 66 million coming in the past couple of quarters then?
The 66 million which came in
quarter 4 of FY20.
So it also had the revenue which we had booked on account of the fit out which we had done in certain places. As we mentioned, we had done certain fit out spaces to certain people in a building, for which the revenue of 2 crore was accounted for as income in the last quarter.
Okay. That answers my question. Thank you.
Thank you. We have next question from the line of Gautam D, an investor. Please go ahead. Mr. Gautam, your line is unmuted. Please go and ask your question.
Sorry. So we have a group company into senior living which is undertaking a project in NCR in asset-light model in joint venture with a developer. So when I see the track record of the developer, it is quite good in commercial, but in residential there have been a lot of quality issues incomplete projects and non-refund of client money. And also they are facing some litigation for 11 years with some PE investor where they have not refunded the money. So I just wanted to understand that since both Max entities are leveraging the same brand and the same legacy in the same region, what implications this will have on our company in the medium to long term, and how do we plan to mitigate them? And particularly given that residential is a quite sensitive space from a regulatory and media perspective, and so I'm assuming senior living will be much more sensitive.
Yeah. Hi, this is Sahil Bachani. I'll take that. Thank you. Actually, there is going to be no impact. So I'll explain to you why. Primarily because Antara, firstly, is not part of Max Ventures. It's part of another listed entity called Max India. But the joint development agreement that they have done is only on the land owned by the landowner, and there is no development or any responsibility that the landowner has. The entire ownership of development, execution of the project is by Antara. So there is no risk of any of the developer past issues passing on to Antara. Second, going forward, Antara has already developed one development in Dehradun, and also this is their second project. They are extremely well positioned to provide services, especially in the current times where health, safety, and hygiene are particularly more important, and also overall well-being is considered of paramount importance. So, in fact, we believe that there is a positive rub-off on the Max brand and impact rather than any negative rub-off and any impact, given that there is complete financial closure for the project that Antara is developing without any dependence on the landowner. And this is not a unique model. This is done by most developers, including Godrej, amongst many others, in various markets, which is an asset-light approach. Having said that, we'll not comment much because it is not part of the Max Ventures business.
Okay. And one question I had on Max Estates. So we are preferring standalone buildings, what my understanding is, which are opportunistic purchases in leasing corridors. So these are not city center buildings, and they are not IT parks or corporate parks, or where there is a lot of common space which can be used and a lot of working space. Most of the offering is within the building. Also, we are not going for large buildings with large floor plate and which are a lot of inside common area. So, and these are not marquee buildings like the Indian Express Towers or a lot of buildings in Manhattan. So my question was, you're putting in this concrete, which is a life of 100 years, and you're taking it all on your books. So just wanted to understand, how do you see this panning out?
I'll take that.
Oh, sorry.
Can you hear me?
Yes,
yeah, I can hear you now.
All right. This is Rishi. I think the best way to answer that question is twofold. Number one, if you look at our latest development, which is Max House, right? Max House will be a part of a campus, and within that campus, we very consciously will also be building provisions for amenities as needed by clients. Number two, if you look at Max Square, Max Square, the way we are designing this 700,000 square feet, unlike of what is seen in that particular micro market, will have all the elements of wellness, F&B, for example, food court, and other amenities to take care of the needs of the occupiers. The third, if you look at Delhi 1, right? Delhi 1 that we have bid for, and hopefully we will be able to have that in our portfolio by the end of this fiscal year, is a 3 million square feet, including Max Towers will be almost 3.6 million square feet. Again, an integrated use campus, which has a combination of high street retail, commercial office, and some service departments. So our strategy is not to go for go for IT parks. That is not what is leading our strategy. What is leading our strategy is in NCR, we first select what is the right micro market to be in. And in that particular micro market, what we do is we very seriously understand the issues and the pain points. And in that particular building, then we provide for right amenities to address that particular need. And of course, all of this should make commercial sense for our investors. So it's more market-backed and customer-backed strategy rather than product-led strategy that we should do a large IT park kind of a campus and then figure out how do we accommodate customers in that particular product. So hopefully that answers it.
Okay. Yeah, that answers it. And so we have built a fair amount of shared assets for Max Towers, which was pending. So these are they monetizable, or is there some income that flows to us from these assets? I mean the parking spaces and other stuff.
Yeah. So maybe we'll request Rohit to take that up in terms of services in the campus.
Yeah, hi. So, we've got a fair amount of shared spaces, and as occupancy is rising in Max Towers, we've been monetizing these on a gradual basis. I think once we've reached 100% occupancy, we will be able to realize the full benefits of all these shared spaces, whether it is in the space that's used for conferences or parking or any other amenities that are getting created. Those revenues will start accruing to us in the near future.
Okay. And one bookkeeping question I had is that when I see the Q3 2020 conference transcript, I see that the area leased out that was owned by us is 156,000 and 158,000 for the sold but leasing rights with us. And in this quarter, I'm seeing a number of 140 and 130. So just wanted to understand, what has caused this. It's a very insignificant migration, but maybe there is some. Generally we have a minimum lock-in. So are there some penalties levied on these clients, or is there some other reason why these clients have moved out?
So if I can answer that, in terms of the space which we have leased out, for which we have the leasing rights, one of the tenants of the might be is evaluating the way forward. And this is what we know. That's the reason we have, as of now, reduced that number from the leasing which we have shown.
Okay. I think that helps. That answers all my questions.
Thank you, sir. To ask a question, participants may press star 1 now. We have next question from the line of Priyanka Singh from Atidan Securities. Please go ahead.
Yeah, good afternoon, sir. I had 2 questions. The first one is, what is the company's cost of debt?
So currently, Priyanka, Hello, Priyanka, the cost of debt.
Background noise.
Yes.
Am I audible now?
Yeah, you're audible. Yeah. Cost of debt is at 10% as we speak for our projects in the real estate business.
Okay. And your packaging film business performance has been great. So what are the factors behind it?
Okay. I'll take it on. This is Amik. So overall, generally, as we shared in the earlier comments, Priyanka, packaging food, the demand has improved because of the hygiene factor expectations, and so some portion of the demand shifting from loose unorganized segment to more branded FMCG segment. That is also the area which is our focus area and our core area. So we see a good healthy demand. I think directionally FMCGs are also stocking up to take care of any movements of any fluctuations in the supply chain that may come. So that is also keeping the demand high. The third point I would say is that our specialty journey, our value strategy, where we remain, strong in terms of a relation and value, specific value add that we provide to the customers. And those segments are remaining healthy, especially with the organized sector, which is continuing their efforts on the recyclability. And so some of our value strategy is for the performance requirement for the antimicrobial, antiviral. The other is on the side of recyclability. So all those put together is actually helping us a lot on our specialty journey. And I said it has a gestation period. So some of the work that we did last year is taking shape now. And directionally, we should be able to get to a point where market fluctuations should be of lesser and lesser reduced impact to us because the products remain strong enough to add the specific value to the customer. So pricing is good, demand supply remains healthy, specialty needs in terms of the food packages increasing, and our value products continue to take a stronger traction into our customer base. Thank you.
Okay. That was quite helpful. Thank you, sir.
Thank you.
Thank you. We have next question from the line of Vikas Atri, and retail investor. Please go ahead.
Hello, good morning. My question is for Sahil Vachani. I would like to know the future pipeline. So we have Delhi one where we have some clarity, and the management had said that they'll also be focusing on Gurgaon. So is there any update on the Gurgaon side?
Sure. Thank you, Vikas. Sahil here. I'll request Rishi to answer that, please.
Yeah, I will take that, Vikas. Hi, good to hear from you.
Thank you.
So in terms of our pipeline, while you are aware of second phase of Max House, which is 0.1, and Max Square, which is 0.7 million square feet, beyond that, we have 4 to 5 million square feet in pipeline, including Delhi 1. And as we speak, to specifically answer your question, we are evaluating a couple of very good opportunities in Gurgaon, and the current environment hopefully will help us get that at a very good price. So once more progress happens on that particular deal, we will come back and update you, but discussions are on.
Okay. So second question I had was, in our Delhi 1 complex, how much will be the commercial leasable area?
Yeah. So, look, in Delhi 1, as we said, Delhi 1 currently our plan is with NCLT. Okay. And we hope that should get cleared by the end of this fiscal year. So we would not like to comment much on Delhi 1 other than what I have already said and mentioned. Overall, this will be a 3 million square feet. And of that, almost 70% will be commercial.
Okay. Sir, regarding Max House Okhla, there is a slight confusion that I have. Is the second phase 1 lakh square feet or 1.7 square feet leasable area?
The leasable area for second phase is exactly same as the first phase. It will be replica of phase 1 with 1,05,000 square feet. Will be the leasable area. Yeah.
Okay. And so my last question is, we've not heard or we've not Arjunjeet Singh is not present, I think, or has he left the company?
Yes. So Arjun has decided to move on to pursue his own family business.
Okay. Thank you. That's it. Thank you.
Thank you, sir. Ladies and gentlemen, due to time constraint, that was the last question. I'd now like to hand the conference over to Mr. Nitin Kansal for closing comments. Over to you, sir.
Thanks, Vikram. I hope we have been able to answer most of your queries. We look forward to your participation in the coming investor calls.